Markets have been under a bit of pressure as investors lower expectations for how much the Federal Reserve may cut interest rates, and the threat of tariffs when President-elect Donald Trump becomes actual president. Those are a few things buffeting the equity markets. But our next guest has some stock picks here to consider amid this market uncertainty. Joining us now is Jamie Murray, portfolio manager and head of research at Murray Wealth Group. Hi there, Jamie. Thanks for being with us.
Yeah, thank you for having me on.
So our viewers love this. Ideas, ideas, ideas. You've got 3 in Canada, 3 in the U.S. Let's get straight to them. You like Chemtrade to kick things off here. They recently increased their distribution. What else do you like?
Yeah, so Chemtrade, I think it's a good spot to start jumping into this name if you don't own it. The stock's down about 15%, really on just some of these headwinds you're talking about. We think there's some tariff concern, commodity prices under pressure a little bit. But this is a name that over the last 3-4 years has really turned itself around. It's cleaned up its balance sheet. It's now buying back stock in addition to paying out that 6% dividend. And this is the second year in a row they've raised the dividend. We think this is becoming the new normal for Chemtrade, and we'll see these 5% increases year on year. And so with a starting point of a 6.7% yield, we think Chemtrade looks very attractive here.
And then Exchange Income, you think, has a unique collection of assets. What more can you tell us?
Sure. So Exchange has 2 parts to their business. One is aviation and aerospace, and the other is more of a manufacturing component. And we really like the aviation and aerospace assets. They own a niche collection of assets, and a lot of it's in northern Canada, flying into remote communities, doing medical evacuation and patient transport for medical needs. And then even just some regional passenger airlines into some of these communities. And what they're able to do is take these collection of businesses, which are each pretty small, and get some scale and leverage. And one example is they're one of the largest purchasers of King aircraft. That's the Beechcraft aircraft in the world, because they have all these smaller businesses across Canada. And that gives them efficiencies on repair and sourcing that other competitors just can't match.
All right, Converge Technology Solutions, an IT services provider. This one had a good run for a while going in 2024, but then it rolled over. But do you believe the cycle has bottomed for this company? Why?
Yeah, exactly. So Converge is an IT service provider, so they sell equipment and software to small and medium-sized businesses. And this is just really coming out of that COVID period when everyone was upgrading equipment and moving to remote work. There's a bit of a boom in this sector, and that's really come off over the last 2 or 3 years. And we think we're at the bottom of the cycle. We think Gen AI is going to cause companies to have to refocus and respend on their technology and software. And that's just going to be a driver for Converge. And this is a company that now, after the share price decline and some operational efficiencies they found over the last year, is going to generate about $100 million in free cash flow in 2025. And on a market cap of just around $700 million, that's a 16% return. And if we're at the bottom of the cycle, we could see that free cash flow number grow as we move into 2026 and 2027.
South of the border, Starbucks is one of your ideas here. Is this really primarily hinging on the new CEO, Brian Niccol, because he has such a reputation for, when he was at Taco Bell and Chipotle, for growing those franchises?
Yeah, that's exactly right. So Starbucks is a name that we think, if you look at what Brian Niccol was able to do with those 2 previous companies and how the share prices of particularly Chipotle responded after he became CEO, it was up 6 or 7-fold over the next decade. And now Starbucks obviously is a very unique company. It has a great distribution network around the world, very loyal customer base, and it's really just about bringing back that casual or non-everyday Starbucks customer. And what we think is really interesting is if the new team at Starbucks can generate and demonstrate value, even just in a small collection of stores, we think investors are going to start to extrapolate that over Starbucks' entire portfolio of 25,000 locations worldwide. And now that could, have a very long multi-year runway of share price increase if they can execute on that plan.
Okay, about a minute left for your other names here in the U.S. The Tapestry, they tried to buy Capri. That was blocked, but you like the underlying business overall. Tell us about that thinking.
Yeah, exactly. Yeah, so Tapestry, they tried to buy a Capri. That's the Michael Kors owner. It didn't go through. Now they're refocusing and doubling down on the Coach brand, and that's their largest brand by revenue and earnings. And that brand, from what we understand, is on fire with Gen Z. Some of the new products are selling out. They're selling at full price, so people are going to the outlet stores looking for a deal, and they're not finding any deals because the demand is so strong for the Coach brand. And this is a company that only trades at about a 14 PE ratio. So we think that as the market comes to appreciate the strength in the Coach brand, you're going to see the share price continue to move higher.
All right, Jamie, your other name is Qualcomm. We thank you for all of those ideas. Thanks very much. We'll talk to you soon.